previous videos, we were looking at how scientific management focuses on increasing productivity. How do we make our particular good or service, and how do we get the most bang for our buck? So what we are looking at now is how do we improve the financials of the organization? So we're continuing to look really at that scientific method approach in terms of how are we going to make the product and what is going to give us the best return? Is there a best way to do things? And so we're looking at the financial needs of the organization. So how much money do we need to start up? Which of these costs are one-time expenditures? What is an ongoing cost? Which costs are fixed? So we pay them, and the more we produce, the more we can spread out that cost. We think about buildings and machines. Those are our fixed costs. In comparison, we have variable costs. So every time we make the good, we need raw materials. That's going to then vary because the more we produce, the more raw materials we're going to need. Which costs are essential for our operations and which ones are more optional? So what we're really looking at is the area of financial management. So we're looking at planning, organizing, directing, and controlling the business functions as they are concerned with profitability, expenses, cash, and credit. In other words, does the organization have the ability to fund its operations? When it comes to financial management, there are different areas of financial management. So treasury management looks at cash flow, accounts receivable, and accounts payable. So we owe people, people owe us, and we're looking at the movement of cash through the organization. Capital structure management looks at where we're going to get the money to fund our operations. Are we going to get loans, so we have debt, or are we going to have investors, and so we have equity? We also have working capital management. This is where we analyze financial ratios and create strategies to ensure that the assets, so our building, our inventory, and our liabilities, so our debt, our loans, are they all managed effectively? So we're going to be calculating some of these financial ratios. And the last thing we're going to look at in this particular area is risk management, so the process of preserving our earnings and assets by minimizing our loss. So as we are looking about how we make our goods or provide our services, we need to include some profit planning. So what is our profit goal? How much money do we want to be making? And we need to think about the volume of sales revenue. How much do we need to sell to make that profit? And what are the expenses that go with that volume of sales? Because, of course, revenue versus expenses tells us our profit. So we might have a profit goal, which we think we can achieve with a certain amount of sales, but recognizing that depending how much you make or how much you sell, it's going to change your costs. So we need to look at sales revenue and expenses so that we can calculate profit. There's a number of calculations that relate to profit, so we're going to work through those. And so we're going to start first by looking at whether our sales are growing. So as we're looking at how well our operations are working, we can look at sales growth. So what is happening in terms of the money we're bringing in? Is it going up? So sales growth is simply the new sales minus the old sales divided by the old sales. And we're looking at, are we selling more over time? So how do you go about increasing your sales? Where does that increase in sales come from? Well, one option, let's get the pen here, is we increase our market share. That is, you find new customers to sell your product to, you expand your customer base. Option number 2 is to increase your product mix. That is, offer new and different types of goods so that the customers you have will buy more from you. So maybe that's a new version. So if you're Apple, you put out a new iPhone every year with better features, and more people will then replace their old one and get a new one. Or if you are selling video games, you have lots of different video games that you sell. And so once the customer is done playing Red Dead Redemption, then they can go on and buy Witcher 3 or something from you, right? So there's lots of different games that you provide, so the customer will keep buying from you. Now, Forbes says a business that is not growing is already beginning to die. Why do we need our sales growth to keep going up and up over time? We need it to go up because we said that profit comes from sales revenue minus our expenses. Well, what do we know about expenses over time? They go up, right? As we have inflation, costs increase to the business, which means we need sales to increase in order to counteract that increase in cost. We recognize it as an organization. Our employees who have more years of experience expect to be paid more than those who are just starting out in the organization. So the cost in terms of our employees goes up over time. So we need our revenue to keep up with that increase in cost. The second thing we can look at in terms of measuring our productivity is the cost of goods sold percentage. So the cost of goods sold is the cost to make or purchase the product. So any costs tied to a unit. So if we think, for example, about the gingerbread house we've been talking about, what are the costs tied to making a house? We had our crackers or cookies, we had our candy. We could even tie labor to that production because we paid people per minute and we knew how many minutes each gingerbread house took. So that's going to be included in the cost of goods sold. In comparison, if we look at like our overhead costs, these are costs that are not tied to a particular unit. So if we have management who we pay, they're not tied to a single unit we're making. When we pay for our building, those types of expenses, that overhead, we pay the electricity, it's not tied to the production of a single unit. We're using it across multiple units. And so the cost of goods sold is specific cost tied to a particular unit that we're producing. You could look at your cost of goods sold in terms of your inventory that's changing over time if you are simply purchasing the products. When we look at cost of goods sold, so our costs over our sales gives us cost of goods sold percentage. And what this tells us then is what percentage of the money we're bringing in is going to the expenses tied directly to our production of that particular unit we're selling. And so we're looking at is what is happening to that cost as a percentage of sales over time. If it's increasing or if it's higher than the competitors, then our business has issues. Our costs are going up, we're going to get less profit. If we have higher costs per sales than our competitors, we're making less profit than our competitors. So really that cost of goods sold is telling us really about what's happening to our profit margin. If you are in the restaurant industry, for example, you can look at those costs, specific costs, relative to your sales. So if we look at just the costs associated with food compared to sales, then typically in the restaurant industry, it's about 25 to 40% of your sales goes to your food costs. If you sell wine, 30 to 50% of wine cost comes from sales. We lose 30 to 50% to the cost of wine for every sale of wine. So you can compare to benchmarks to see how your organization is doing compared to the cost as a percentage of sales in the industry itself. So of course you want your cost to be lower as a percentage of sales so you can keep more profits. If we take our cost of goods sold, so all the costs tied to the units of production, and we add any additional labor costs that are not tied to production, so that would be like upper management, then in the restaurant industry and in retail, it should be less than 65% of your gross or sales revenue. So you can compare how your organization is doing in terms of these benchmarks. So overhead percentages are the costs that are not tied directly to a good or service. So we talked before in terms of like the building, management salaries, utilities, so the electricity, also things like insurance. And then you have departments within your organization where the people working for them, it isn't tied directly to one product. It spans the whole company. So we're looking at like advertising department, payroll. And so these salaries are part of overhead. And as we said just a moment ago, if you take the cost of goods sold plus the labor costs that come out of overhead in retail and food, you should be less than 65% of your sales. When you are looking at overhead percentage, and as overhead as a percentage of sales, you don't want it to grow. You don't want the overhead to grow faster than sales. So this percentage should not be going up. Your sales can go up. Ideally, you want the overhead to not change dramatically. So your overhead percentage is falling. That is, you are able to spread out the cost of all those managements and the departments like advertising and payroll across more units being produced. And so those costs per unit go down. When we look at cost of goods sold, if your organization does not make goods, then you might refer to them as cost of revenue or cost of sales. So for service industries, we often see cost of revenue or cost of sales instead of COGS. All right, so let's look at some COGS. So here's Microsoft. Here we have their revenue, their sales. Here we have our cost of revenue. So we can take our 49.3 in terms of revenue. We can take our 15.6 in terms of the cost of revenue, and we can find our cost of goods sold percentage. So what is 15.6 billion divided by 49.3 billion? We get our COGS are equal to 32%. Okay. All right, well, what about Apple? So Apple has revenue of 97.7 billion. Some of their revenue comes from services and some of it comes from goods. So we have revenue of 97.7 billion. We have cost of revenue of 54.7 billion. 54.7 billion divided by 97.7 billion, we get our cost of goods sold percentage, and we get 56%. So notice that Apple has a much higher cost of goods sold percentage than Microsoft. But notice Microsoft is all services. So the production of these services has a lot less expenses. We don't need a building. We don't need fancy equipment. Manufacturing of goods has a lot more costs. Providing of services, really the cost is your people. So we would expect the cost of goods sold to be smaller with a company that provides services than a company that produces goods. And this, of course, will impact profits because the higher your costs, the lower your profits. So let's look then at the idea of gross profit. So gross profit is the difference between your sales and the cost of goods sold. So if we go back here to Apple and Microsoft, so we'll just start at the top. If we're looking for gross profit, which Microsoft is listing right here, we simply would take our 49.3 billion minus our 15.6 billion, and we get 33.7 billion gross profit for Microsoft. In comparison, if we're looking at Apple, we need to take our 97.7 billion, subtract our 54.7 billion, and you're going to get gross profit here of 42.6 billion. So notice in this visual here, we've actually broken out the gross profit into the amount in gross profit for services and those for devices. We can add in a third comparator here. Here's Amazon. So Amazon has revenue of 116.4. Their cost of sales is 66.5. So you can see the gross profit then calculation. We get 49.9 billion. So when we're comparing these institutions, these different companies, when we look at their gross profit, we see Amazon was sitting at 49.9, Apple was sitting around 43, Microsoft around 34. So they're seeing similar amounts in terms of their gross profits as these big giant tech companies. We can look at what is called gross margin. Gross margin takes that gross profit and turns it into a percentage of sales. So sales minus the cost of goods sold, right? That's our gross profit. So we can take gross profit, oops, I just dropped my pen, and we can divide it by sales. All right. So let's look at gross margin. You can find gross margin as sales minus cost of goods sold divided by sales. You can find it as gross profit divided by sales, or you can find it as 100% minus the cost of goods sold percentage. Okay. So let's go find our gross margin. Gross margin, of course, must cover the overhead, any financing costs, taxes, and profits. So remember, gross margin is based on gross profit. So that's just sales minus the costs that we can tie directly to the units. So it doesn't include any of that management cost or utilities or any loans we have to pay interest on or any taxes or any of that final profit that we get to keep. All right, so let's take a look at some of these companies here. So gross profit. Gross profit is 33.7 billion for Microsoft. If we divide that by the 49.3 billion, so 33.7 divided by 49.3, what do you get? We get about 68% as the gross margin. So you can actually see it listed on this little infographic here. So Microsoft has a gross margin about 68%. All right, Apple, we take gross profit of 42.6 billion. We divide by that sales revenue of 97.7 billion. And when you do that, you get a gross margin of how much? 44%. Now notice the COGS percentage is 56%, so we could just have taken 100% minus 56%, right? And we would have gotten that same 44%. Same thing back up here with Microsoft. Instead of taking gross profit divided by revenue and calculating that 68%, we could have simply taken 100% minus 32%, and we get that 68%. All right, let's look at Amazon here. So to find our gross margin, we would take 49.9, our gross profit, divide by our revenue of 116.4 billion. We do that, we get 43% in terms of the gross profit. Okay. All right, let's look at one more. Let's look at Tesla. I got that one somewhere in this queue here. Tesla, here we go. All right, so let's look at Tesla and how it compares to Microsoft and Apple and Amazon. So here we have our revenue of 16.9 billion. We could, of course, take 16.9 billion, subtract our 12.7 billion cost of revenue. Revenue minus the cost of revenue gives you what? That gives you our gross profit. Okay. If we took 12.7 billion and divide by the 16.9 billion, what would that number give us? That's our COGS percentage. Okay. And if we want to find gross margin, we do what? We take our gross profit, that 4.2 billion, and we could take that 4.2 billion, we could divide by our revenue of 16.9 billion, and that would give us that gross margin of 25%. So you can see for Tesla, they have a gross margin of 25% compared to Apple at 36%. And we had Amazon at 43%. Okay. And Microsoft sitting at 44%. So you can see in terms of Tesla's gross margin, it is lower than the other three. Of course, because gross margin is based on gross profit, and gross profit is revenue minus cost of revenue, anything that makes goods is going to have a much higher cost per unit. And so the gross margins will be lower with companies that make goods than those that make services. Because most of the costs for service-based there's a lot more overhead, a lot less in terms of tied to per unit production. Oh, looks like we got Google here as well. So let's just do one last one. All right, so we have revenue of 68 billion. We subtract 29.6 billion, and that revenue minus the cost of revenue gives us what? That gives us our gross profit, which in this case is 38.4 billion. If we took 29.6 divided by that 68 billion, that would give us what? That would give us our cost of goods sold percentage. Okay. And we can find our gross margin by taking our 38.4 billion, dividing it by our 68 billion. That gives us our gross margin, which here is about 56%. So notice Google, which is providing services, has a much higher gross margin. And in fact, Google has a higher gross margin than all of the other examples we've looked at so far: Amazon, Apple, Microsoft, and Tesla. So what we can do is we can take this information that we're gathering and start building an income statement. So we first have our sales or revenue. We subtract the cost of sales or the cost of goods sold, and that gives us our gross profit. If we then subtract from there our operating expenses, so this is our overhead. This is the cost not tied to a particular unit. Once you subtract that, you get your operating profit, or EBIT. EBIT is earnings before interest. Should lay this down to write it: interest and taxes. So this is our profit before we've taken out any interest we owe and any taxes we owe. We can then add or subtract any non-operating income and expenses. So these are unique one-time flows of money in or out. So for example, let's suppose that we decide to relocate our operations. So we're going to have some additional expenses related to that move. Maybe we're involved in a lawsuit, so we have lawyer expenses. Those are all non-operating expenses. If we sell off a portion of the organization and so we make money from that, we have non-operating income. So these are unique changes to the organization. We add the non-operating income, we subtract the non-operating expenses. That's going to give us our net profit before taxes. We then subtract the income tax, and that will give us our net profit after taxes. So these pieces here make up what is an income statement. If we look at this Google example, we can, for example, see the parts of our income statement. So here we have our sales revenue minus the cost of revenue. So that's going to give us our gross profit. Once we have our gross profit, we subtract any operating expenses. That's our overhead. And so for Google, that's divided up into research and development, sales and marketing, and then more general management. So we had our revenue minus cost of revenue equals gross profit minus operating expenses gives us the operating profit. Here's where you could add or subtract any non-operating income or expenses. That gives us then our net profit before taxes. If we then subtract out our taxes, we're left with that net profit after taxes. So you can see how on this infographic we have many of the parts of that income statement. So if you're working along on our gingerbread house that we've been working on for the last couple weeks, take a moment to calculate the cost of goods sold. So how much did it cost for you to make your gingerbread house? So what are the costs that are tied to your production? So for me, I had one worker working for 2 minutes. So that was 66 cents. I had 3 crackers or cookies. They were 30 cents each. They were 10 cents each. So that's 30 cents. And I had 1 gumdrop at a penny. So I had that cost here of 0.01. So my total cost here was 97 cents. So those are all costs tied to a particular gingerbread house. So my cost of goods sold for my one gingerbread house was 97 cents. Because my gingerbread house was very basic, so not even the picture that you see here, but even simpler than that, it had 1 decoration and 3 crackers. It could only sell for $3. So then my gross profit is $3 divided by the 97 cents it took to make it. And so you can see that my gross profit is right around $2. How can we improve the profitability for our gingerbread house? Well, if you're changing gross profit, you either need the value to go up or the cost to go down. So I need a way to make the gingerbread house that takes less time or takes less material. That will make my cost of goods sold go down. Or I need a gingerbread house that's worth more. So I need to be able to find customers who are willing to pay a higher price, in which case my sales revenue would increase. So I need either my sales revenue to go up or I need my cost of goods sold to go down. So if you're working through that demo with us, then talk about how you could improve your profitability for your gingerbread house and calculate your cost of goods sold and your gross profits.